Seema, ringing the bell at the Nasdaq today. Buzzing for that, I'm sure. Always look up. Don't you always look up around the opening bell and people emphatically clap and wave their hands?
Even when it's down, which is always kind of interesting to me.
I always find that weird. If we're down today, will you scream and shout and
I'm still going to clap.
You're still going to clap, even if we're down. Okay.
She's paid to clap.
Opportunities to buy. There you go.
Is that going to be your story whilst you're here? The opportunities to buy this?
On today, no. I have to say, I think there's worse to come for the market, unfortunately. You know, you talk about we talk all this time about the Fed, about inflation, about growth, and then you add in all these additional geopolitical pressures. It's very difficult to find anything to be positive about at the moment, and a lot of these things I don't think is fully priced into the market either. Earnings seasons, of course, is going to be really interesting. We are expecting to see weakness starting to really feed through now. A lot of the narrative about margin pressures, but also just generally starting to feel the pressure of consumers potentially pulling back from next year. So there's a lot, I think, to be concerned about for investors.
When you say it's not priced yet, out of everything you've just said, what isn't priced?
I still think that the recession is not priced. Right, so I think the market is eventually, I mean, look, it keeps switching every few days, but I think generally speaking, the market is coming to terms with the idea that rates are going to go higher and they're going to stay there for longer as well. The bit that the market is still playing around with is this recession. You know, a lot of people still thinking that soft landing is possible. We think it's very unlikely. And with recession, unfortunately, does come earnings recession.
So which aspects of the market are not sufficiently priced? Because some people might look at retail, for example. They might look at some of the semiconductors, and they'll say recession's priced there. Where is it not? Or is it even the 40% decline on semiconductors that has not fully appreciated the depth of this downturn, not just whether there will be a technical recession?
So like you said, I think there are segments of the market which really have struggled, and semiconductors have been one of them. Unfortunately, the latest news probably suggests that there could be even further downward movement from there. So valuations at this kind of stage, they are instructive, but they're not going to tell the full story. So in the same way, in the last 5-10 years, we've known that valuations are very expensive, but it hasn't stopped markets from going up. Cheap valuations don't necessarily mean that markets are not going to go down further.
I was reading a piece of research over the weekend, which was talking about how if you look at some of the AAII sentiment, it looks really bearish. People say they're feeling terrible, things are going to go down. And then you look at their actual positioning, and they're still pretty invested in equities. They're still actually fairly bullish, at least in terms of their positioning. What's the trigger to wash that out?
So I think I'm not sure if you're going to see necessarily a washing out, because even from today, you know, we are expecting further declines. But the one question that keeps coming up, I've been traveling around the US in the last week, the one question keeps coming up is like, but when is this floor going to come? When can I start buying? Right, so that is the question that people are trying to figure out. When is the timing for them to increase their exposure? And I think at this stage, you know, if we look at historical bear market cycles, your average downfall is 27%. Now, if you're down 24% and you don't think this is going to be like the GFC, then we're more than halfway there. So if you're not already underweight, this is probably not the time to start reducing even further.
What do they ask you about Europe when you tour this country? How much do they hate that market right now?
So much, but I understand that, and actually I fully agree with that perspective for Europe. It is a very, very challenging time, and I think that what we're starting to see in the US is they are understanding that actually in Europe the situation is considerably worse. And put on top of that is there's so many things that we cannot predict. We're not meteorologists. We cannot predict what the weather's going to be. No one in the whole world probably can predict what's going on in Putin's head. So with those two incredible uncertainties, despite European valuations being so cheap, this is probably not the time to increase your exposure when you have those two things hanging over you.
You talked about the persistence of this, particularly around rates, that we could be living with this for the next 12 months or so. Then that's also a conversation taking place much more so in Europe now, that we could be living with this for more than one winter, maybe two, perhaps even longer. When you start to think about the United States in that respect, 10 years ago we talk about the United States decoupling from the mess that was playing out in Europe. Is that still the case? Would you say that's still the case?
I think it is to some extent. I mean, one of the things that we are starting to feel is that in the US, there is this belief that there is a complete decoupling. But of course, that doesn't happen. You know, Europe, whatever European tensions there are, whatever the energy situation is, there will be leakage into the US. In Europe, you're already seeing this huge substitution from natural gas towards oil. And of course, there will be inevitable repercussions for the US as well. So I don't think it's a full decoupling. I think the US does come out better than Europe, but certainly not complete decoupling.
Okay, so bear with me, but everyone who I know is going to Europe for a vacation, including Tom Keene, who's over in Europe right now, and we're hearing about the negative effect from the strong dollar on U.S. companies, but that's because things are on sale effectively from, say, European industrials. So when is the currency differential a good thing for Europe the way it used to be, say, 5 years ago when the currency wars were reversed?
Well, I think you've already seen some of that play out this summer, which is why you haven't seen European GDP actually contract yet. If you look at Spain, Italy, all of the southern European countries have benefited significantly from the weak currency. And that is going to moderate a little bit some of the downturn that Europe's going to feel. But this is, I mean, from an investment perspective, for the US, it's one of the key reasons why we've been overweight mid-caps rather than large cap. The mid-cap exposure to domestic is significantly higher than what you see for large cap. And, you know, they've outperformed, and we expect them to continue to outperform.
One theme that we've heard from a lot of the investors who we speak with is it's starting to look attractive to go into longer dated bonds. How much conviction do you have around that kind of view, both in the U.S., but also in places like Europe?
So we have, for example, increased our exposure to long-dated bonds fairly significantly in the last 2 months. A couple of reasons. One is that we are, as I said, expecting recession to hit next year. And in that environment, typically, you should see downward pressure on yields. But like you said, in Europe, there's the added pressure. What are central banks doing? They're raising rates, but they're also pushing down the long end. Or at least they're trying to push down the long end. At some point, there's going to be some kind of success, or at least it's going to stop any further movement. So if you have to be anywhere in the yield curve, I would rather be on the long end than the short end, for sure.
In the gilt market or treasuries?
I don't think you want to be in the UK.
I asked the question because you're based in London. I just wondered whether you've been buying gilts in the last couple of weeks.
We did not foresee what was going to happen to the gilt market, like anyone else, I think. Just generally speaking, the UK, we have serious concerns about. The fiscal story is not going to improve, I think, as much as they can walk back. There are certain segments of that political story, the fiscal story, that they're going to stick to. So if you're looking at it over a longer-term horizon, the UK has a worse inflation problem. It's got a worse growth problem. So if I had to pick one over the other, I would pick the US.
Halloween budget, what do you want from that?
As an economist, I want them to unwind everything.
Yeah.
Unwind everything, just go back to having some serious fiscal policy where they're trying to actually balance the budget in the same way that really in the UK, unlike many other countries, fiscal balancing is a hallmark of fiscal policy for the last 2 decades. So for them to walk away from it at this time is a very difficult time. In 2 or 3 years' time, who knows, trickle-down economics could work.